equity has two types.
Okay.
One is preference equity and another one is common equity. Preference equity and common equity. Common equity holders, they are like real owner.
Okay.
Voting rights.
Okay.
Corporate action benefit. Right. And high liquidity. How? Because security is tradable on listed stock exchange. Stock exchange. So any doubt in it?
No.
Common equity. Okay.
No.
So what is equity then? If you sometime you would see question like equity means shares even. Okay. What is shares or what is common equity? Total company's capital divided into the equal denomination or units. So each units we can call the shares or share something which you can say, and that shares can be can be your preference equity, common equity and preference equity. This one, write down this the valuable point. If you see any question on what is shares or what is common equity and preference equity, so about common equity, so you should highlight this, and the dividend also, that flexible dividend. These are the key features, and apart from that the important one is repayment of share capital after the preference shares. Right, after the preference shares. We'll discuss about common equity only, and we'll cover a few more points about it. So sometime you would expect question like what is earning per shares. Again, this is related with your dividend portion. Earning per shares. So write down one example. Let's say company earn 1000 rupees profit. Total number of outstanding shareholders are, let's say, 100. So what is meant by outstanding? Outstanding, it means shareholders, they are holding the security. They are holding the security.
Okay.
Right?
Okay.
So that security which you can call outstanding. Outstanding. So it's a liability eventually. And that's the reason we record this to the liability side of balance sheet even. It's a liability of the business. Outstanding, whenever we use word like outstanding, so it means that is your liability and which will be recorded in the balance sheet of liability side. Okay. So now here we are going to calculate earning per share. So if you see the total earning, net earning, after deduction of interest payment, taxes, and even dividend, for the preference holders. So net earning goes around 1000 rupees. But this net net 1000 rupees is from 100 outstanding shares, right? Correct?
Okay.
Are you getting me? Because this 100 rupees is belong to the 100 shareholders. But we are looking for earning, means income, for per shares. EPS, earning per shares, profit per shares, net profit per shares. That we are going to calculate here. So EPS would be your, see, EPS would be total distributable profit divided by number of outstanding shares. Or total profit also, which you can say. Total profit earned. So it's very simple. This is your rule or formula which you can say and calculate it now. Total profit 1000. Total number of outstanding shares which is 100. Then do this calculation. 10 for per share should be earning per shares. There is no rocket science. It's just a simple calculation. But sometime you would expect questions how you calculate the earning per shares. Earning, it means it's a profit after deduction of everything. So total profit divided by number of outstanding shares or securities. Right?
Okay.
So here under equity you would expect this question, and again preference equity as well you would expect, but that the ratio of dividend would be fixed. That's what we will discuss later on. So we'll cover the common equity first.
Yes.
then
Equity and
sometime you
shares
would
is equity and shares are same, right? You are mentioning
sorry, equity,
and shares.
equity and
Okay.
shares, that is same.
Same. Okay. That's it.
Okay,
Okay. Okay.
that's what I mentioned, shares oblique equity. Shares has a two types or equity has a two types. Anyways, that is like same. Then apart from this, you would expect question on or terms which is earning per shares or maybe diluted earning per shares. Okay, that would be difficult for you. Then okay, debt to equity ratio. Sometime you would expect questions how we calculate a debt to equity ratio. Debt to equity ratio. See, debt to equity, it should be 1 or less than this. Right? So why? Let's say equity capital value. Value is 100. Then bond value should be less than equity value, this value less than equity capital. Value. In that case only you can think from an investment aspect that okay, so this can be a good company, so which can help to generate the alpha. Otherwise, if the debt, let's say the bond capital is 200, then see, equity capital is 100 and your bond capital is 200, so debt to ratio, it goes around 1:2. So it means for per equity value, so you have a liability of 200. So means for every one equity you would see, so there is a high liability on this company. And eventually, if this company declare as a bankrupt, or maybe this company declare as a that they want to shut down their business operations, equity holders value will be zero automatically, just because of due to high debt. The point here is very simple. The debt should be less. If it is a zero debt company, then that is good. If it is not, but at least it should like less than 1 or up to 1, not more than that. If it is a high debt, then you would see the problems. Okay, so where you may expect these two ratios questions in your interview process. Now we'll talk about preference equity. Preference equity or shares. Common feature as usual. So common feature should be fixed dividend, right? So equity holders received, preference equity holder receive fixed dividend on a periodic basis, maybe quarterly or annually, or maybe at the time of maturity, that depends. Preferential voting right, preferential, so in a special situation only they received preference voting right. Repayment of capital early, Then the equity capital. This is important one. Repayment of a capital early than the equity capital, right? Fixed dividend, preferential voting right, repayment of capital early than the equity capital, and choice at maturity. What choice at maturity? That is also important. Choice, it means redemption or conversion. Conversion into, again, common stock, or maybe redemption into cash. That is depends. So it means choice. You have a choice at maturity. You can take the decision if you are a preference equity holder. So you can take the decision whether you want cash or conversion into common stock. These are the important features which you would see. And apart from that, if you compare with the common equity, here the preference equities are illiquid. Why illiquid? Because you cannot easily buy and sell the preference stock.
Okay.
It's not a listed one.
Yes. I liquid means we cannot buy and sell the.
Easily, you can easy to buy and sell.
Yeah. Yes.
Is not the listed on exchange, stock exchange. So this entire key things which is required when someone asks about what is preference equity. So you should tell that okay, so preference equity means it is that the preference equity holders received fixed dividends as well as they receive preferential voting rights, and in terms of repayment of capital, of course they received early repayment of capital than the common equity capital. Alright. And apart from that, one of the key feature which preference equity holders they carry, which is choice at maturity in terms of redemption and conversion. See this, all the valid point, it should be there in your answer. So are you writing this right? All?
Yes. Plus, you can send me the screenshot, right?
Sorry.
This one. You can record this session, right, and send it to me.
Yes, but practice it. See, write it
I
down
guess
in your way. I would say would be helpful you to understand it.
Sure. So because I'll start writing.
Because listening is not.
Because
that
when
will not help you a lot.
After taking session, I'll go through these points and I'll read them.
Okay. Yeah, you can.
Then only I can have the question right. Yes. Okay.
And then different types of preference shares. Types of preference shares. Here you would expect, sometime you would expect question, what are the different types of preference shares? The important one will cover on the basis of redemption. So it means a redeemable at maturity, irredeemable. Irredeemable at maturity. So it's like a equity feature. So it will not be redeemed in the life of that particular business. So it means it will be redeemed at the business maturity, I would say, not the equity, that the preference equity maturity. That's what we call it irredeemable at a maturity. It will be redeemed at the time of shut down the business only. Redeemable, it means, let's say the duration is, let's say, for 10 years. So after 10 years, this equity will be redeemed. So redeem, it means that the equity will be converted into cash. So cash will process to you and preference equities will be debited from your account. That's the process we have. Cash, it's like conversion, right? Conversion into or redemption into cash, right? On the basis of redemption. Then another would be on the basis of conversion. Convertible preference shares. Into common equity. And non-convertible. Again, non-convertible, it means it's like irredeemable at maturity. Same, it will redeem at the time of shut down the business activities. So non-convertible. And another type, which is convertible preference shares into the common stock. How it will convert at the time, let's say the duration is again 10 year. So after the 10 years, let's say you're holding one preference shares. So that will convert into common stock. Let's say 10 common stock. Why 10 common stock? Let's say preference equity has a value around 100 and common equity value is around 10. So it means you will receive 10 common stocks to you in your account at the time of maturity. There is no impact on value. Value will be remain same whether you received 10 equities or one. So there is no change on value that you will receive after the 10 years. So as simple as that. So it's just conversion. Preference equity will be converted into common stock, and here it will have a choice, and that is the best part of preference equity, where they offer the choice to the investors. So you can, it's like an option where you can hold the right whether you want to exercise that or not. If you want to exercise, then exercise it. If you exercise it, then you will receive 10 equities.
1 minute. Let's go ahead. Hello. Good.
Okay.
You can hear me?
And the another part is on the basis of cumulative, in terms of dividend, that the feature is talking about. So what is cumulative? Cumulative, it means, let's say in the first quarter dividend was offered 10, right?
Okay.
Let's say it was like 10% on invested capital. In quarter 2, so dividend will receive to you 10 again for next quarter, right? But on this portion also, which you would expect 10%, so which goes around plus 1, so 11 rupees which you can expect dividend, because it is like cumulative compounding, dividend on dividend. If you see this feature, cumulative, non-cumulative. Non-cumulative, it means it's a normal. Cumulative, it means your dividend will be cumulate, and that will be paid to you at the end of the year. At the end of the year. So entire dividend will be paid to you at the end of the year. So that dividend which we can call cumulative dividend. Third quarter, again the value would be like 10 plus 1, which is 11. So on 11 you would expect 10% plus, that is 10 rupees, so which goes around 1.11 something. So total dividend would be 11.11 something. Fourth year, again this value will increase, and that's around total dividend, if you calculate 10 plus 11, which is 21. Here it would be total value 21. Here the value would be around 33.11 something, 32.11 something, 32.11 something, and at quarter 4 it goes around 43, 45 around, so which the dividend amount will receive to you at the end of the year. If you see this feature, that would be your cumulative basis, compounding, dividend on dividend. But most of the time companies, they offer the convertible preference shares and redeemable at a maturity. The reason is it's like a liability. Okay, it's like a bond feature, because bond also carries same feature. There is no change in it, except this cumulative part. Bond carries all the feature: redeemable at maturity, convertible into preference or common stock, right? You would see that feature. But yeah, these are the popular one, so at least you should know about all this. Now you can ask your questions related to this preference and common equity. How we create common equity or preference shares? Let's say total assets. Total assets of the business, let's say 10,000. So you can split this 10,000 into units or maybe shares, and that shares you can sell it as a shares. So how many units that you can split, that is depends on the business. Simple. You can also, you can create 10,000 units as well. That is depends. So per unit value would be 1 rupees. This would be a face value. You can create this also. Ten thousand.
Okay.
Total assets split into different. So assets can be, so your question again would be like, what would be the assets for the business? Office, buildings, furniture, technology, talent, brand value. It can be anything. Cash at bank. Patent. These would be your assets. So their value, you can, let's say their entire value is around 10,000 rupees. So 10,000 rupees, you can split it into 10,000 units, and that units you can sell it to investors. That is the process which we have.
The equity, right? Preference equity.
Sorry?
In the preference equity, right?
Your voice is echoing. Can you please speak a little bit loud or increase the volume of your system then?
Can you hear me now? Can you hear me now?
Yeah, go ahead.
Yes, this is preference shares equity, right?
Coupons.
No, not coupons. Preference shares, right?
Coupon shares.
Coupon shares.
Coupon shares, which is something, see, coupon shares, here you would say in a preference equity, you would see which is warrants. It's like a coupon, so which will offer to the that is preference shareholders, right? So it's like rights, so which they can hold at the time of maturity, so the investors can take the decision on the basis of situation. So that process we can also call coupon. It's like a coupon, but it's not pure coupon, it's like a warrant. Warrants gives the right to the shareholders to buy or sell the assets. But yeah, it's like a coupon that you can say. Coupon feature, and another way, the other way we can say like coupon, it means it's like a dividend which we received fixed. It's a coupon feature. So bond carries coupon feature. The similar way preference equity carries that fixed dividend feature. So it's like a coupon, so which you can relate. Okay. Bonds. What is bonds?
Acknowledgement of the company debt.
What is bonds? Bonds. Agreement between issuers and investors. Agreement between issuers and investors we call bonds.
Issuer and investor.
Right? Bonds, it means it's agreement between issuers and investors. So that bonds gives the right to the bondholder to sell the asset of the issuer to sell the asset of the issuer if issuer failed to make the payment. So payment can be interest payment, or principal payment. Payment can be interest payment and principal payment. Because it's a small piece of paper like this, defined terms, let's say value, which is 100, shit, entire vanish out. What happened? Piece of paper, face value 100, interest payment maybe 5% for per year, 2% for per year. So which defined everything. Apart from that, you would see the company name and seal of a company. Seal of a company. Seal, it means it's an acknowledgement of debt. Acknowledgement of debt. Acknowledgement of debt. It is acknowledged. Seal, it means it's acknowledgement of debt. So company is now acknowledging that yes, we are borrowing money from you, and that's what we are giving you. It's like an acknowledgement, so which you can claim if we deny to pay the payment in future. Right? And if you want to see how the bonds it looks like, I'll show you that as well. Okay, that is not here then. Hello, can you hear me? Hello, can you hear me? Satish? Hello. Satish?